फेसबुक पे डाले थे।
Please join me in welcoming our speaker, Dheeraj Parihar. Yeah, hi Dheeraj.
Yeah, hi Sudeep.
How are you?
Yeah, I'm doing great. Thank you. Good morning.
So you can share your screen now.
Okay. I hope you can see my screen.
Yeah, I can see your screen. Have a great session. Thanks.
Okay, perfect.
Yeah.
So, so we are going to cover a hands-on introduction to time series forecasting today. I hope everyone is doing great and good morning to everyone. So let's start. So as you know about myself, that the Sudeep already have given introduction about myself. So I'm going to cover this part. So we are starting with some kind of the polls, as well as getting to know with each other how much experience you guys having in forecasting, like time series forecasting, as well as in the Python as well. And so this is the agenda for today. Let
पीछे
me
आवाज आ रही है
cover
पीछे।
that agenda. So today's agenda, we are having very simple. We are going to cover the fundamental of time series. Then we are going to talk about what are the special features of time series data we are having. And then we are going to look at the various descriptive analysis on the time series data, means the very basic things, how we can plot, how we can decompose the time series, and how we can infer some kind of relationship so that we can use that information for model building. Then we are going to look at some code for various model trainings and evaluation, means how we are going to build a model on this time series data, and how we can evaluate a model and how we can utilize that model for prediction at the final level. That's we are going to talk about it. So I think we can start right now with one poll here. So can we have poll here? First poll. Okay, so the first question, what we are trying to understand about yourself, guys, how much experience do you have in coding and with Python? Why forecast? Why we need the forecasting, and what is it? So let's talk about some kind of problem statement or pain areas for the various organizations are facing right now. Like we are having a lot of data, and we are having a lot of internal and external risks associated with our business, such as the high competition, failure of technology, inflation, recession. Everybody is right now talking about the inflation and recession, that recession is coming up. So how we can proactively predict all these things, and what kind of data we need for that? If you are going to change any kind of government laws, right? If you want to predict the stock prices, if you want to predict any kind of things which is like contagious nature, all these things, so we can use the forecast. Every business operates under risk and uncertainty. Okay, so the data science is all about what are the data we are having in the historical form, and how we can leverage that data, and how we can infer some kind of relationship between various features, various variables or various factors, and how we can predict something that in terms of probability what is going to happen. A risk associated, if I'll say one example, that the churn modeling or churn analytics in telecom industry, or you can say the employee are resigning from the companies, right? So that is the risk associated with that. So we can easily answer to the business that, hey, there are 90% chances of risk, or 80% risk is associated with all this in churn. So forecast is very necessary to lessen the adverse effect of risk. So if we can proactively predict something, then definitely we can, the business leaders can make an informed decision to reduce or to mitigate those kind of the effects of risk. What is it actually? A time series is a sequence of measurement on a same variable collected over time. So the data looks like here, it is a time dependent data. So a lot of data is like cross sectional data, or like unstructured data, like image data, or you can have speech data, or you can have different like natural language data. But here in the time series data, you should have to understand that, okay, this is a sequence basis events, as well as that should be collected over time period of time, as example year on year, month on month, or hourly basis. If you can take one example of stock price, right? The stock price of any kind of the banking sector or any kind of healthcare sector, every stock price is having a various a specific time frame. Either it would be second level, minute, like minute level, hourly level, quarterly level, monthly level, or yearly level. So that's called as a time series sequences. and the data should be captured at a regular time interval. So that's the time series data we are going to look. So if you can look at here intervals of the time series data, as having said that, yearly means if you're going to look at your GDP. So government, like if you can look at the various governments are taking care of the GDP at like yearly level, right? Revenue at the quarterly level. Suppose one company is running their business, and we can look at their balance sheet and how the profit and loss they are making, and how much revenue they are generating. So every companies are rolling out their revenue information the quarterly level, right? Or yearly level as well. Monthly, if you can look at sales, suppose we are running a business or we are running a retail shop, and how much sales we have done, like what is the trend, like it is increasing sales or decreasing sales, right? If you can look at one example, that in COVID-19, like 2 years back, everyone was locked down, and the sales was decreased, right? That's the monthly trend, a month on month, because we got 3 months lockdown, then again extension of the 2 months lockdown. So if you can look at that data, that it will show that okay, there is a decrease, like a decrement happening in terms of the sales. Demand and forecast, everyone is aware of the I think demand right now. If you can look at some research right now, that the auto industry are facing some kind of the problem with the chip manufacturing, right? So during COVID-19, the people thought that they forecasted that due to COVID-19, the demand of the chip would be very less, but that's not the correct assumptions the people what thought, right? So demand was very very high. That's why right now, if you're going to book any kind of car and also, you are getting 6 month or 1 year waiting period because of that demand. So if we are having any kind of mismatch with the demand and supply, then definitely it is going to create a problem. That's why forecast came to the picture, and we can utilize the historical data, and we can make some kind of things. But COVID-19 was some kind of irregular pattern, and that was not captured historically. That was the different thing, that is the some kind of uncertainty associated all the time. That's we call as a irregular pattern or random component. Daily, the stock prices, right? The market open as 9:15, and we are having every stocks are running like hourly basis, or you can look at the 10 minutes or 15 minutes basis, that how much fluctuation is going on up and down. Okay, that's called the daily. So there is a lot of data is associated with the time dependent, that's we call as an interval of time series. The next part is very very important to understand what is not a time series. Okay, so there are few examples. If you are collecting the data at different time interval, correct? Suppose one data you have taken in hourly basis, and another data you have taken the yearly basis, and then you have merged, then we can't take care of that one. So proper scaling or proper time frame is very very important at the regular time interval. So if you are having the data like this, then that's not a time series. If you are having multiple items at same point of time, it's not a time series. When the time period are not the same, as I having said that, if you are having yearly basis data and hourly basis data, so if you are going to merge, then that's not a time series data. So we have to keep in mind that okay, what kind of the data looks like time series, where we can build a model, and what data is not like a time series. So there are some applications we encounter during time series data. So I'm just going to talk about various few applications which is very very helpful to understand why we need the time series forecasting. So the first application, we talk about the manpower requirements from the historical data and take a decision regarding hiring. Not only just hiring, we can make a decision about their retention as well, right? The people are leaving the organization due to some areas or due to some kind of problem. Okay, the problem could be anything. The problem could be their career growth, the problem could be compensation, problem could be their psychological impact, or the policy changes within the organization. So how we can leverage the historical data, and how we can make informed decision to retention them or to hire a right candidate. Another question, like another business application, is related to the portfolio managers and like stock movement. Suppose if I want to invest my money for my future investment, then how we can make a decision that how I can build a diverse portfolio, right? Where their portfolio managers come into the picture, and they are making a decision from our behalf that okay, you can invest here and there. But So there is a two thing: either they have good experience, like 20 years of experience, like portfolio managers, and based on their experience they can make a decision. But if you can look at their experience, they have learned all the patterns, right? But here we are talking about in terms of algorithm. So algorithm is taking care of all the patterns, and it can recognize, or it can find the every signals and the pattern to find out the best portfolio, the balance. But sometimes the managers or as a human we can make a mistake, but algorithm is not making any kind of mistakes, because of the whatever the data we are providing, it is just learning from them. Another business application is like dynamic pricing. So dynamic pricing about the hotels, about the airline tickets, about the different kind of hotels properties, right? So that is the one other application where we can forecast what would be the best price for that particular area. Other application is something like that. Yeah, it's the same thing I already have covered, that if we want to give some kind of discount, right? If you are going to book a hotel in Goa, or Sikkim, or Thailand, so how we can forecast what would be the dynamic price, and how much discount I can offer you, so that I can attract more customers, and that can directly proportional to your revenue growth, right? So in the short, time series data is being collected and utilized in all the data driven decision mechanism. So this is very helpful business application where business leaders can make a very informed decision, and they can generate revenue more. So these are the various applications we are having in time series. What are the special features of time series data has? What are the special features? The first basic important feature is that data are not independent. So data, because as I said earlier, that this is a sequence based information, right? One event happened, then other event happened, then third event happened, then fourth event happened. All the events are related with each other. Okay, they should have some kind of relationship. So data, uh, if the data are independent, so that's not a time series data. So data should be dependent. Other thing is that one defining characteristic of time series is that the list of observation where the ordering matters. That's very important. Suppose if you are collecting the data on quarterly basis, right now it is a 2022 is running, right? So if I can collect the data from 2015, so 15 I can collect Q1, Q2, Q3, Q4 in the sequence basis. Then I'll go with the 2016, then 2017 in the same sequence. That's we need. But suppose if you're changing the order, as example, you have taken quarter one, quarter two for 2015, and then all of a sudden you have taken quarter four for 2017. So if you are going to change the order, then that's not a good sequence for your model building, because the forecasting is taking care of your recent observation or sequence pattern to analyze what would be the next outcome. Correct. Ordering is very important because there is a dependency, and changing the order will change the data structure. That's very important. So orders are very important. Sometimes yeah, we are coming to that missing data. Sometimes what is happening, that we are having a lot of missing data, and generally it occurs if you are going to look at our structured data like cross sectional data or unstructured data. There is a lot of missing values are there. But uh, but that's very important, that in time series data we should not have missing information. If we are having missing information, it means that we are going to break the sequence. And if your data is having the break in between, then I think that's not good thing. So there are the various kind of approaches or techniques to impute the missing values. So in the cross-sectional data, there are different strategy to impute the missing values, right? Mean, mode, median, or you can take care of any kind of algorithm like random forest or KNN to impute your missing values. But in the time series data, we do have some kind of different interpolation mechanism, which we can leverage to impute the missing values, as well as we can leverage some kind of algorithms as well, like KNN and all, to impute the missing values. So we have to make sure that the missing values is not uh, uh, it should not be present in my data, and if it is there, then we have to impute the missing values before building a model. That's very important. So let's talk about some kind of time series component. Whenever we are having data, so we are going to do a lot of data exploration and all, right? So what are the time series component we are having? So basic time series component, we have trend, we have seasonal component, and we do have irregular component. So let's talk about very basic things about trend. What is a trend? So generally we are looking at the trend like a decreasing trend or increasing trend, and we talk about in terms of the cumulative trend, right? Which is, I can say that okay, this is on an average year on year or month on month. That's called as either your sales are going to decrease or your sales going to increase. But sometimes we can have little fluctuations where it can be little bit up and down, right? But overall trend, we can say that it is increasing or decreasing trend, right? There are another trend component is the seasonal component. That's very important in terms of your time series forecasting, because interpretation is very important. So representing intra-year stable fluctuations, repeatable year after year with respect to timing, direction, magnitude. Let's talk about one example: demand of winter clothes. We know that if you are living in North India, so we are having specific seasons where we are having a lot of like less temperature and all. So in that particular seasons we are going to buy a lot of winter clothes, right? But if you are going to look at your summer seasons, nobody is going to buy winter clothes, if you can leave some kind of exceptions, right? So the demand of winter clothes would be very high in that particular season. That's why we need to supply that product a lot in that particular seasons. So that's why demand and supply, we have to match the demand and supply to fulfill the requirement and to generate the revenue. Incidence of influenza or incidence of malaria, these are the various infectious disease which can spread out in very specific seasons, right? Like in generally in summer seasons, it is not going to. That's why if you can look at some kind of research or research paper, if you can look at these kind of diseases are not spreading a lot in winter, okay, but in the summer season it is spreading a lot. So these are the very seasonal component, and whenever we are doing a lot of analysis or descriptive analysis, we have to take care of the trend, we have to take care of the seasonal component. There is a error is everywhere, and how much error is associated with that, that is called as a random component. And it is also known as an irregular component, or it is also known as a white noise, or variability associated with the series in the irregular component or random component. This does not contribute to forecasting. Okay, so whenever we are going to build a model, so it is going to take care of your trend, it is going to take care of cyclicity, or if it is going to take care of your seasonal component. But irregular component is terms of like your error. So that's not going to contribute in your forecasting, but that's very important to know how much error we are having, like 10% the component is related to irregular component. So that's we are going to look at during coding, when I'm going to look at the coding and all, like, and how we can take those kind of separate trend. We have to decompose the time series, and then we can look at how much variation and how much effect we are having in terms of sales or revenue. Okay, if you can look at here decomposition of the model. So generally we are having one the data of time series data, and we have to decompose our data into various small pieces. And those pieces is like your seasonal component at period t, trend cycle component at period t. Trend cycle means it is a positive trend or negative trend, or very sample, some kind of thing, neutral trend. And there is one other component, the irregular or remainder or random component at period of t. There could be two kind of model. One is additive model and one is multiplicative model. So additive model is very good where whenever you are having seasonal variation is relatively constant over time. Okay, suppose you are having year on year sales data, and in each year you are having increasing trend, suppose, but seasonals are average. If you are going to look at your average seasonal, then it will be, if it is relatively constant over time, that that's called as a additive model. But if you can look at one example, that multiplicative model, where we can use multiplicative model, if you can look at if volume is increasing year on year, as example passenger volume. If you are going to collect the data of air travel by the passengers, right? So year on year, the passengers volume is also increasing and your variation is also increasing, right? Over there we can use multiplicative model, and multiplicative model is like your trend multiplied by seasonality multiplied by error. Or also you can write in terms of logarithmic scale, and that would, if you can take log of that one multiplicative model, that would become additive model. So that's a little bit mathematical orientation about additive and mathematical model. What is the forecast range? So very long range forecasts do not work well. So the meaning of that one, if you are going to take the very long ranges, sometimes it is not working well, right? And we have to take care of the recent observation. Recent observation matters a lot. If you're going to look at 10 years previous data, that could be a lot of businesses has been changes, a lot of methodologies has been changed, and the data also has been changed. So we can say like data drift. Okay, so every 5 years or every 10 years, it depends on data to data or business to business, data drift is happening. What is the data drift? Data drift is the one concept that at each time period of time, if your data changes, data behavior, data pattern changes, that's called the data drift. So if data drift are there, then I think long ranges forecasts do not work well. Then how we can take care of that? Let's have a look some kind of examples why this is not going to help a lot here. So if you can look at no change in the market, there will no change in the market. If there is no change in the market, that's fine. We can leverage very simple model. If the change is gradual, not a drastic change, that's fine. The financial crash like 2008 US market will send all forecasts into dizzy. It means that something happened in 2008 and no one have predicted that one. If it is there, then I think you can't take those kind of data to predict like forecast, and we can't rely on the forecast. As example, the recent example that COVID-19, right? Nobody have expected that COVID-19 and that happened, and that has changed a lot of data points, right? Data drift happened drastically. So if you can take the 5 years of the data and you are also including the 2 years of data which COVID-19 pandemic, then I think that would be a wrong forecast, and we have to take care of that very seriously. Events like demonetization would throw the forecast into disarray. So these are very uncertain events which happen and nobody have predicted, and these are the signals which is giving very wrong information to our model, right? So always whenever we are going to do forecast, we have to take care of whatever the data you are going to select. The data, the pattern is constant or not. Is there any kind of significant pattern happen or signals we have to capture, and why it is happen, so that we can take an informed decision that what kind of data we need. So always in the time series forecasting or any kind of machine learning or deep learning, the data is very very important. So someone said that data is oil, right? And machine learning models or time series models or deep learning models are okay, but you have to focus more on the data, what kind of data you are selecting. If you are selecting the wrong data, if you are selecting the wrong information and you are feeding into your model, so model will give the wrong information. So always we have to focus more on what kind of data we are selecting, what kind of pre-processing technique we are going to take care of my data. Okay, so it says that if you are putting the garbage in, definitely you are going to get the garbage out. So garbage in, garbage out. So always we have to take care of the data, what kind of data we are selecting. And these are the garbages like your demonetization, your 2008 US market crisis, and COVID-19. These are the data garbages, so we have to take care of very seriously before building model. So let's move to the next slide, the simple forecast. So today we are going to talk about very simplest forecast, and then we'll go for some kind of advanced forecast like exponential smoothing. And apart from that, so today I'm going to cover the four basic models. And apart from that, there are the various models which we can leverage. So first simple model is the knife forecast. What do you mean by knife forecast? Knife forecast nothing but just look at your last observed value. Suppose you want to forecast today's temperature, just look at your previous day temperature. That would be your forecast. If yesterday's temperature was 35-degree, then you can say that hey, today is also 35-degree, or tomorrow would be based on my today's temperature. Okay, that is the simple in knife forecast. The second forecast would be that average forecast value. So this is taking care of the mean of all past observation, easiest, and it is intuitive and naive. So what we have to do here, we have to make a window here. Okay. So example, you want to forecast today's temperature. Just look at the 3 days back and just look at the average temperature. Means it is a simple calculation of the mean, right? X1, X2, X3, just you can add and divide by 3. Okay, you can set up window of 6 month, window of 12 months. It depends. So we can try different windows, and we can look at our RMSE score where my observed value as well as my actual value is having minimum differences. Okay, so we'll look into it, this code as well. This is very very simplest and easiest and intuitive approach. Then yeah, that's again one other example of the moving average forecast. So Yeah, so I have explained this window. So the average forecast is just taking care of all the observation previously. Just take a mean value, that would be your forecast. Moving average forecast is just take a window of 3 months or 6 months or 12 months. That would be your moving average forecast. That's we are going to look at with the pictures, like with the graphs and the code as well. Then fourth is exponential smoothing forecast. So what is the exponential smoothing forecast? So what we are generally, as we have seen that there is a lot of challenges, right? Some kind of garbages are there in our data. Then sometimes these moving average forecasts cannot work well because of there is a garbage, like COVID-19 or 2008 US crisis. So what we can do, we can just take a weighted average of the past of the observation, means the latest past observation. Okay, weight decays as observation get older. As I said earlier, that if you are collecting the 10 years of your data and there is a lot of observations happen, which is like a garbage and that's not giving the proper signals, and as the time we are going to further away, the weight of that particular observation would be lesser. Okay, so the basic idea here is that whenever you are trying to forecast, for example, tomorrow's temperature, day after tomorrow's temperature, always look at your just past observation, very which is very recent, and give higher weightage to your past observation. And as you are going farther away, just decrease your weight accordingly. That is the exponential smoothing is doing. Okay, and one or more parameters control how fast the weight decays. So we do have different strategy here. We have, if you can look at here, the parameters in SES is nothing but simple exponential smoothing. DES is your double exponential smoothing, and TES is your triple exponential smoothing. So as we know that in our time series data, we do have various levels. We have trend, we have seasonal component, right? We seasonal means your seasonality. And so if we want to capture all these things and we have to make a decision like what would be the next the forecast value, so we have to control all these things. So what SES is doing, like simple exponential smoothing. So there is one parameter is alpha is level is nothing but this is just your the average value for the past observation. If your alpha value is closer to 1, forecast follow the actual observation more closely, right? More closely means your recent observation. As example, if I want to forecast today's temperature, it will give high weightage to my yesterday's temperature. Then it will give the little bit less weightage to yesterday before temperature. And if alpha is closer to 0, forecasts are farther from the actual observation and the line is smooth. So we have to tune this alpha value and the beta value and gamma value, and we have to look at, okay, what are the optimal parameter combination is giving the best result. That's we are going to look at in our coding exercise. Okay, so double exponential smoothing having like dual parameter. One is alpha talk about your level nothing but your the past observation in terms of your averages like mean value, and the beta is your trend. If you have positive trend or negative trend, so beta will talk about it, right? And this dual exponential smoothing, we can take care of that when we have trend but no seasonality. Whenever we are going to decompose our time series data, right? So so easily we can look at, okay, my data is having trend is positive or negative, is my data is having seasonality or not. So based on that we can make a decision that, okay, what kind of value we can take for our model building. Then the third one is that TES, which is triple exponential smoothing. It is have alpha beta gamma. So alpha is level, beta is trend, and gamma is your seasonality. So we have to take care of all these things during model exercise. Model validation, yeah, that's very important. If you are aware of the normal machine learning model and all, what we are doing, we are just taking 70-30 ratio or 80-20 ratio, and we are taking a random sample. Okay, so we are simply just taking the 80% random sample for training my model and 20% random sample for my validating my model. But here in time series, as we know that the sequence matters, orders matters. So we are not going to take a random sample, we are going to take a proper order of 70 or 80% data, and after that again I'm going to take my validation data in proper order. That's the difference between your means the traditional machine learning model building and the time series model building. What kind of model evaluation criteria we can take, means what is the metric we can choose. So if you can look at to choose your metrics, the best one is your RMSE. Okay, so basic idea is here that yt is your, if you can look at here, yt is your the actual value And yt hat, so I can say that this is yt hat, this is my observed the value, or you can say that forecasted value. And we can take here square root of, because magnitude we need to take, it doesn't matter it is a positive or negative, that's why we are taking square. And then you can take here the under root, right? So either you can take here mean absolute deviation, or mean absolute percentage error, or mean sum of square, or residual sum square. These are the matches we are going to choose, and we are going to select by like best model. And there is a one concept of confidence interval whenever we are going to do a forecast. So there is a upper bound and lower bound we are going to take. Like the my forecast always going to lie in between my lower bound and upper bound. That is a confidence interval. Okay, so whenever we are going to predict a certain point into the future, we might need to have a concept of confidence band or interval of our prediction. That gives us a range of values in which our prediction will be lying in the future, or the future timestamp. Okay, so it's simply a concept of how confident we are for our prediction, and that would give some kind of sense to the business leader that okay, is my forecast values are in the properly shape, or it is not crossing that bound. If it is crossing that bound, it means that something is wrong. Again, we have to look at back our data, and we have to do some kind of pre-processing. So that's all about the basic fundamental of your time series data. So we have learned what is the time series data, why we need it, various business applications, how we can encounter the time series data, and what are the special features time series data is having, what are the basic models we are having time series data. So there are various models are available, like arima model, sarima model, sarimax model, and lstm model. These are the again the family of the models which we can leverage. But in the today's class, like in today's session, we are going to talk about only these four basic models, and we'll look into it how it is going to perform, and how we are going to look at our model. So these are the end of the slide, like theory part, and I think we can look at some kind of the poll right now. Whatever we have seen so far in the slide, then just we are gonna look at about your understanding, what you have learned, and I think that would be more interested. Can we have poll for the one question like related to time series forecasting? Okay, look at